In 1978, two friends, Bernie Marcus and Arthur Blank, were fired from home improvement store called Handy Dan. After that, they met at a coffee shop in New Jersey and decided to create a store for the do-it-yourself crowd. They called it Home Depot. 45 years later, Home Depot is the largest home improvement retailer in the United States. And Handy Dan went out of business 10 years after firing Bernie and Arthur. Since the IPO in 1983, the stock of the Home Depot went up by over 126,000%. So to find out if Home Depot is still an interesting investment opportunity, we will analyze it, value it, and also we will take a very close look at the dividend. So first, let's see who owns this company. Individual insiders, that is an X at 0.1% of the company owned by individual insiders. And we would like to see this number over 2% to make sure that the management has its skin in the game. Unfortunately, it is not the case here. And are individual insiders buying right now? That is an X. In the last year, we see buy transactions worth under $1 million and sell transactions worth over $28.5 million. And do super investors own this company? That is a check with 8 super investors, including people like Thomas Geithner, David Katz, Terry Smith, and Lee Ainsley. And are they buying right now? That is a check. In the last quarter, they bought over 91,000 shares and sold over 46,000 shares. Return on invested capital. That is a check at an incredible 31.5% 10-year median returns. And we want to see this number higher than 10%, so that is absolutely exceptional. It shows what a great job the management is doing. And free cash flow growth? It is an X at 7.2% 10-year compound annual growth rate. And just as with return on invested capital, we would like to see this number higher than 10%. So it is not a very low growth, but we could hope for it to be a little bit higher. And what do we know about the net profit margin? It is a check at 10.9%, and the industry average is 8.7%. So we see here a decent advantage over the competitors. And now let's take a look at share buyback. It is a check. In the last 10 years, they bought back 29.2% of their shares. That is really impressive. It builds value for the shareholders because if there are less shares outstanding, then every share that we own represents a bigger part of the company and its earnings. And the debt? It is an X. It would take over 3.5 years to pay the long-term debt with a current free cash flow. So that is not ideal. We would prefer it to be under 2 years. The dividend yield is 2.9%. So for every share, you get annually $8.36. And the payout ratio? That is a check at 46.7%. And we want to see the payout ratio somewhere between 20 and 50%. So if you are concentrating on dividends as an investor, this payout ratio is really nice. On one hand, it is a lot of money that you are getting. On the other hand, it is not so much that it could actually hurt the company. And what about dividend growth? It is a check at 16.1% 5-year growth rate. This is an exceptional growth rate. They are paying dividends since 1989, and this dividend is growing every year for the last 13 years. So if this growth rate were to last, it would double your dividend in under 5 years and quadruple it in 10 years. But is such a scenario really possible? Well, they did it in the past, so we will just have to wait and see. To value Home Depot, we will have to estimate its growth for the next 10 years. And we will make 3 scenarios: low, medium, and a high one. So in the low scenario, we will estimate a growth of 3% for the entire 10 years. In the medium, 5% for the first 5 years, and then 6%. And in the high scenario, 7% and then 10% growth. And why did I choose such estimates? Well, if we look at the last 10 years, we see a revenue growth of 7.7%, free cash flow growth of 7.2%, and earnings per share growth of 18.7%. And that is mainly due to a lot of share buybacks. So I think that the numbers that we use for these calculations are pretty conservative. And that is exactly what we want when we are valuing a company. So with such estimates, the intrinsic value in the low scenario is $116, in the medium $146, and in the high scenario $188. And when we add a 30% margin of safety, we get $81 in the low scenario, in the medium $102, and in the high one $132. And the current price is around $295. So it is all in the red and by quite a big margin. So Home Depot is a company with an exceptional return on invested capital, equally exceptional share buyback program, and a really nice growing dividend. Unfortunately, at the same time, it does have a little bit too much debt, at least for my liking. And as we just saw, it is an expensive stock. Even if you want to concentrate only on the growing dividend, you still have to take into consideration the price you are paying for it. And right now it just seems a little bit too high. If you want to see the analysis of Home Depot's main competitor, Lowe's, then click here. And if you want to find 3 great dividend stocks, then click here. Thanks for watching and see you in the next one.